Have you noticed that sometimes getting a loan is cheap, and other times it feels like the bank wants your soul, or maybe your savings account suddenly starts paying more interest than it used to? It all comes down to interest rates. But what exactly are interest rates? Who decides them? And most importantly, why do they keep changing? Let's break it down. Simply. At its core, an interest rate is the cost of money. When you borrow money, you pay interest. When you save money, you earn interest. It's like a rental fee. If you borrow $1,000, the lender charges you interest as a thank you for using their money. If you deposit money into a bank, they pay you interest because they're using your money to make more money by lending it out to others. So interest is the price of borrowing and the reward for saving. Now, here's where it gets interesting. In most countries, interest rates are heavily influenced by a central bank. In the US, that's the Federal Reserve. In Europe, it's the European Central Bank. Other countries have their own versions too. These central banks set what's called a base rate or policy rate. This is the interest rate at which they lend money to commercial banks. When the base rate goes up or down, banks follow. And so do the rates on mortgages, credit cards, car loans, and savings accounts. So in short, when central banks change the base rate, they're basically steering the entire economy. Okay, so why do they actually change the rate? It all depends on what's happening in the economy. Let's say the economy is heating up. People are spending a lot. Businesses are booming. But now, prices are rising too fast. That's inflation. To cool things down, the central bank raises interest rates. That makes borrowing more expensive. People and businesses borrow less, spend less, and inflation slows down. On the flip side, imagine a recession. Unemployment is high. People aren't spending. Businesses are struggling. Now the central bank might lower interest rates. Borrowing becomes cheaper. This encourages people to take loans, buy houses, start businesses, and hopefully revive the economy. So in short, raise rates, fighting inflation. Lower rates, fighting recession. Keep rates stable. Economy is balanced. For now. All right, but how does this affect you? Let's break it down. Home loans and mortgages. When interest rates go up, monthly payments on new mortgages go up too. That dream house might cost you way more over time. Credit cards and personal loans. Higher interest rates mean more expensive debt. Suddenly, that unpaid credit card balance is burning a hole in your wallet. Car loans. Your car might not be as affordable when the rates climb. Business loans. For companies, borrowing to expand gets more expensive. That means fewer jobs, fewer pay raises, and less innovation. Savings accounts and bonds. Here's the upside. When interest rates go up, savings accounts start paying better returns. So if you're saving instead of spending, you win. It's all connected. A single rate change can ripple through every corner of the economy, from the coffee shop down the street to Wall Street itself. So let's recap. Interest rates are the cost of borrowing and the reward for saving. Central banks set base rates to control inflation, growth, and economic stability. They raise rates to cool things down and lower them to boost activity. And every time they do, it impacts everything from your loan payments to your savings balance. So the next time you hear the central bank raised interest rates, you'll know exactly what it means and how it hits your wallet. If you found this helpful, give it a like so the algorithm knows we're not completely useless. And if you want more simple explanations for complicated stuff, hit that subscribe button. We've got plenty more coming.